Good morning and welcome to the CARCLO PLC preliminary results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Nick Sanders, CEO, and Phil White, CFO. Good morning to you both.
Morning.
Thank you. Good morning. Thanks, Alessandro. Good morning to everybody. Thank you for joining us. This is the second time we've done the annual results presentation through Investor Meets Company. We got some really good feedback last time, and so it's something that we want to keep doing because we think it's really value added, and it enlivens all of the documents that we've published about our results. So introducing myself and Phil, you've met before. I've been chairman since August 2021. Phil joined in early 20. Phil joined in early 21. So we've been at the helm now between us for about 18 months or so. So let's move on and get on to the presentation, please, if you could, Alessandro. So what we're going to do today is give you an overview of the business because I think it's helpful to really focus on the three key things that move the dial in terms of value in this business. That's the performance of our CTP Plastics Division, the performance of our Aero Division, and also the pension deficit. And so in my part of the presentation, I'm going to talk you through those three elements. Phil will then do the financial overview, and then we'll do the summary and outlook at the end, and obviously then move on to questions as well. So let's move on to the next slide, please. So just giving you an overview of CTP and the group. So what I've tried to do here is to remind you of the relative sizes of the two divisions. So CTP, you see, by far the biggest part of the business. But actually, aerospace is also a very profitable business and a growing business. And so although we talk a lot about CTP, in this presentation, I also want to just recap on where we are with the Aero Division and the sort of things that we're doing. And you can see for the year that last year's presentation was called Preparing for Growth. This year, we're calling it Growing to Plan because we have grown quite substantially. And you'll see that our revenues grew by nearly 20% in the last year, which we think is a good performance in the current climate. And our EBITDA also increased by about 20%. And all of that, despite the well-published economic global headwinds that you'll have read about: inflation, shortages, lead times, headcount, recruitment problems. So we think that's a pretty good result in the circumstances. The CTP revenues were up by 21%. They enjoyed increasing sales again, particularly in medical and diagnostic. Aerospace actually came down somewhat in the year in terms of sales because in the prior year, as it entered the pandemic period, it had got a fair order backlog to burn off. But what has happened in aerospace this year is that the orders, particularly in the second half, have consistently exceeded the sales, and we continue to grow into this new year. So our EBITDA up to 13.1 million from the prior year. And our strategy, what we're trying to do with the business, is the same as it was before, which is we're trying to grow both divisions through investing in CapEx. 20% of growth on the top line needs CapEx to make sure we've got the capacity. Strengthening management in a number of areas, whether it be operations, whether it be finance, whether it be business development, and also improving our processes. So we've been taking a long, hard look at the processes in the divisions and the businesses, and looking at making sure we strengthen those and make them as efficient as possible. The IIS pension deficit reduced very substantially by 11.3 million down to 26 million. and we'll explain the factors that contributed to that, but that is a very significant reduction. And what we really found, though, is that it was a year of two halves, and Phil is going to go on and talk about this, in that coming out of the pandemic, in H1, the world seemed to be recovering, there were shortages, but in H2, we got a lot more effects, labour shortages, inventory or supply issues from our suppliers, cost inflation. So H2 was very different from H1, and we'll talk about that as we go through the presentation. Our balance sheet has strengthened. Our net assets more than trebled to 24 million as a result of the profits and the pension reductions, deficit reductions. And I think when we look at the markets that we operate in, and there'll be more on this in a minute or two, then we can see that the end market demand remains strong, but there will be those continuing operational challenges that almost all manufacturing businesses are currently facing. So if we move on to the next slide, please. So just a reminder about our CTP division and its focus. And you can see that nearly 3/4 of the business is in the medical and diagnostic sector. But electronics and optics are actually quite important to us as well. And what we see in terms of growth profiles is that medical and diagnostic has enjoyed continuing growth, in a lot of investment from our customers in new product developments, which feeds through to us. But electronics and optics also particularly, we think have good growth opportunities. And on the right-hand side, what I've tried to do is just give you some sort of recent history on how the division has performed. So you'll see that the dark green bar is the product sales, the light green is the tooling sales. That's where we're developing tooling that our customers pay for either replacements for worn out tooling or for new products. And you can see in 2022 that we've really resumed the growth pattern with good product sales, but also with good tooling sales. And of course, the tooling sales are a good, hopefully, precursor to future production sales coming up. And then we've also put onto that graph as well the EBITDA, and you can see that what we got was some EBITDA growth in the division, but not in line with what you would expect from that degree of sales growth, and that's all down to some of the inflationary pressures that we experienced, particularly in the second half. So we do see that strong demand is continuing in our main markets, which is good. The tooling sales, as I said, is an encouraging sign for the future. Our big customers are, putting a lot of their future business intentions with us, so that's good. And we have changed the way in which we operate this division. That up until the last 18 months or so, this business really felt like a series of plastics businesses that operated in different geographies. We've moved this year to really make it work as an integrated whole, and we've changed the way the management structure works so that there's far more of a global approach, because our customers, by and large, are global in nature. They want product from us in various different locations, so to minimize transport and shipping. So our view is that we have to act and structure ourselves in a way which is much more of a global business. And I think that also positions ourselves for better growth in the future. So we've talked a lot about the headwinds. So what were they? And this was particularly evident in the second half. We had quite a lot of labour shortages, particularly in the US. Some of the COVID bills that were passed by the US government actually discouraged quite a lot of people from entering the workforce. But also as well, it did have the impact of inflating salaries across the whole number of sectors. And we found it very challenging to recruit people, though in recent weeks that's starting now to tail off a little bit as harsher economic times look to be around the corner. Material and energy obviously have inflated. Our materials are mainly come from resins, which are oil based. So we've got the impact of oil prices going through there and energy inflation. And within our contracts, by and large, we're allowed to pass through material cost increases, but that's with a little bit of a time lag. But energy inflation, labour and other things were not part of our contractual price increases. So we've had to go back and renegotiate contracts with almost all of our customers to try and make sure that we recover in a fair and balanced way the cost impacts that have hit our business. So what that inevitably does is there's a time lag in doing that. So generally with materials, it takes about 3 months from one of our input pricing increases to passing that through to an end customer. And obviously as well, we had to go through the process with other cost increases of negotiating those with our customers. But we did that 2 or 3 months ago now, and they're embedded into the business now. And so that's a big part of us recovering some of the impacts that we saw in the second half. Logistics delays seem to be somewhat easing at the moment. China has been a particular difficulty with lockdowns in Shanghai, getting ships in and out of the ports. But generally, supply chains have settled down a little bit, but we are still holding more inventory, really to give us some security about supply. But what we intend to do is progressively burn that off as we go through the next year. And as I've already mentioned, we've taken quite a lot of efforts and time put into strengthening operational management and these systems and processes. We've introduced a number of new processes to the shop floor to help make us more efficient, reduce scrap, and make sure that we're absolutely maximising the capital equipment that we've got. So if you move on to the next one, please, Alessandro. So aerospace, obviously a smaller division, but our sales here broken down by new production being about 2/3 of it. And a lot of that new production is linked to Airbus. So as you'll have seen, Airbus are increasing their build rates for the single aisle aircraft progressively over the next couple of years. So during the pandemic, obviously build rates were cut substantially, but that's now coming back. And the next biggest sector, the quarter of it, is the spares. And again, those are spares that mainly go into single aisle aircraft, but also some of the older Airbus aircraft. And of course, as aircraft have started to be used more, then demand for spares goes up. And we've got the vintage part of the market, which is relatively stable. So on the right-hand side, you can see the impact that the pandemic had on the aero business. So it was growing quite nicely. Then the pandemic came and demand dropped. But what we are seeing is that the order books have, particularly in the second half of last year, really have strengthened somewhat, quite a lot. And that gives us confidence about looking forward. Interestingly, in this business, because the contracts are constructed in a different way, our ability to pass through inflationary costs through to customers has been easier for us to do because we tend to quote on a job-by-job basis. And that has allowed us to therefore maintain our margins at pretty healthy levels there. And we see that continuing in the future. We are now investing in the growth of this business. It's a small business, but it's a profitable business, and it has that capability to grow. So we've recruited more business development resources, which has allowed us to get out to approach new customers, and we're already now starting to get orders in from people we've not worked with before. We've got various new pieces of equipment coming through. Some of it is to replace older kit, but also some of it is to increase capacity. And as I said, despite the economic pressures, we've been able to maintain the margins pretty well in that business. So small, but a very important part of the group. Next slide, please, Alessandro. So moving on to the pension deficit, I mean, you can see here on the left-hand side, just how the deficit in the light green, the IAS 19 deficit, has decreased, and that substantial step down in the last 12 months. I'll ask Phil in a minute just to talk through the various ups and downs. That it's a complex picture and a number of different factors that feed into the deficit moving. And so I'll ask Phil to just to talk about the bridge in a minute. But as you know, pension deficits are measured in a number of different ways. IAS 19 is the one that goes into the accounts, but we also obviously have the technical provisions related to the actuarial valuation. And you can see at the bottom of the slide there that the actuarial valuations are completed on a triennial basis. So the March 18 valuation was 90.4. That's now reduced with just very shortly the triennial report for March 21 will be issued, and that shows that the deficit has reduced just below 83 million, but that's a draft number at this stage. So you can see that by both measures, the pension deficit is starting to move, but it is complex, and there's a number of different factors that can move for you or against you. And so, Phil, do you just want to talk through just the bridge and the key factors there, please?
Yeah, thanks, Nick. Hello, everyone. Thanks for joining us today. So you see, we started on an IAS 19 basis at 37 million and moved to 26. And the biggest move is in the change in actuarial assumptions. And this is dominated really by two areas. One is the discount rates for the liabilities, which moved from 2% to 2.7%. And that has quite a significant impact on the deficit. So I think for every 0.25% on the discount rate, we're talking around 6.7 million effect. Against that, you do have an inflation offset. So the equivalent 0.25% inflation would be about a third of that, 2.3 million. So inflation doesn't always go hand in hand with discount rates, but there tends to be some kind of trend where it offsets the discount rate impact. So as the discount rates increase, then which they are doing recently, and we'll talk about that in one of the questions shortly, it can have a beneficial effect on the deficit reduction. The other main areas are we make contributions, as we'll read in the accounts, to the pension scheme, and additional contributions were also scheduled in the last agreement, tripartite agreement between the pension trustees and the bank, and the contributions are a gross 3.9 million for the year. Against that, we offset the pension admin costs that come out of that, including PPF levy. So there's 1.2 million coming against that. So the cash effect for the actual scheme is a 2.7 million pounds benefit, in that is a contribution to reducing the deficit. Then asset returns, we're doing quite well for most of the year, but then quarter four, of course, we had the Russia-Ukraine conflict, and the equity market dropped pretty significantly. So that finished negative for the year. And then there's just some smaller elements, which basically there was a pension increase exchange, which is known as PI, which initiative that we introduced, which gave members more options to basically, in lieu of rights to indexation of pension, they can take a higher pension earlier, and gives them more options for what they want to do with the pension. That actually eases the pressure on the pension scheme itself, and contributed a 0.85 million gain. And then there was 0.1 or rounded to 0.2 restructuring and rationalization costs against, beg your pardon, interest on liabilities was 0.7 million, which is a notional interest on the pension, and is part of their IAS 19 requirements. So it's 0.9 minus 0.7 is 0.2 rounded.
Thank you, Phil. I just want to say that one of the important things that is really happening is that the management team at CARCLO and the pension trustees are working very well together in a really collaborative way to make sure that we're doing everything we can through the contributions and the initiatives and the investment strategy to make sure that there's real focus on reducing that deficit. And I think it's encouraging progress this year, but as I said, the reduction is a result of all these different factors, some of which are not in our control. So if you can move on to the next one, please, Alessandro. So just to really remind you on our strategy, and these are the three broad chunks that we focus on. So in CTP, it's about organic growth, and it's about focusing on our existing customers, particularly in the medical and diagnostic sector. We serve almost all of the big players now. And really what we're trying to do is develop the ability to sell to them globally rather than on a country by country basis. And that really is getting some traction. So it's customers we know with products we know, but producing them in different parts of the world. The continued investment in CapEx and strengthening the management, that has to continue as we secure that growth. And we're really focusing our operational improvement strategy around improving the return on capital employed in the business. This is something you'll see later on. Our ROCE number isn't that grand at the moment, but it has improved, and it's an area where we want to focus on to make sure that we really are making the best use of all the capital that's employed in the business, that we're sweating the assets. And then from an operational point of view, part of the global plan is that we have little room to expand in some countries. We've got floor space available in others, and we're trying to make sure that we use that to its full extent to absolutely maximize the floor space that we've got. But we do think that as our customers grow and expand their operations over time, we will be looking to expand our manufacturing base as we use up all the available space that we've currently got in the group. With aerospace, again, it's about organic growth, but it's focusing on those niche markets that we're already in, which is cut cables of various description, thread rolling, and some simple machining. That's where we stay focused on. That's the right strategy for a business of this size. And it's about acquiring new customers who want products in those niches. And that's why we've increased the focus and the resources on business development. And we do foresee actually that having cut the business back through the pandemic, we're growing again now, and we're looking at plans to make sure that we can continue to grow the business operationally, having had to sort of cut back. And that's about people, and it's about machinery, and we've got plans in hand to make sure that hand in hand with the growth, we can resource up to make sure we can meet customer demand. And then finally, on the pension, we will continue to work closely with the trustees to reduce the deficit going forward. I think that the last 12 months has seen a lot of activity, which will hopefully bear fruit in the years to come anyway. So with that, I'm going to hand over to Phil, and Phil is going to take you through some of the more financial detail. And at the end, I'll pull it all together and we'll do the questions and answers. So over to you, Phil.
Thanks, Nick. Okay, so in terms of the full year ended 31st of March, we'll put some punctuation to the prelims that you'll now have seen released last week. And you'll have seen group revenue up £21 million, a pretty healthy number. You can split that really into two for CTP. The CTP growth of 10.8 on tooling and 10.6 on manufacturing, 21.4 in total. Fairly even split, and two quite different reasons for the growth there. On the manufacturing, the growth does include a high level of input cost inflation passing through into revenue, and this has some effects overall, but we'll go into that in a bit more detail later. The aerospace revenue, as Nick has already said, down 0.4 million, but we have orders which have just continually exceeded sales over the year, and it's great to see the upturn has come pretty early against what the market was expecting. We're already seeing, a good upturn in orders, and that's very encouraging for the longer term pipeline. And the orders do tend to get scheduled over quite a long period of time in aerospace, so they're not all immediate. On the underlying operating profit, 6.1 million, up 1.3 on 2021. And going back to the return on revenue, despite very high cost inflation impacts, especially in the second half of the year, we've still registered an increased return on revenue of 4.7% against 4.5% the previous year. That translates into an 8.2 million operating profit. That includes the forgiveness of the US COVID loan, which formed a grant income in the income statement, and we separately disclose that because of its materiality, and that makes 8.2 million. So we just take it out of some of the underlying calculations so that we've got more like-for-like comparability. Further gains were made in the statutory operating profit through 0.7 million exceptional gains, and then we have 0.4 million lower operating profit than last year, which was also high at 9.3. And we can see two main factors there. We've got the higher underlying profit of 1.3 million that we registered 6.1 against 4.8, but against that lower non-recurring gains, but still very substantial non-recurring gains. So we still made 2.8 million this year and a very high gain of 4.5 last year. And just recapping on what that was, this year we've got, as mentioned, the 2.1 million US loan income from the forgiveness of the post-COVID loan. And we also have 0.9 million pension credits. That's the PI pension increase exchange that we mentioned earlier. And then set against that 0.1 million rationalisation restructuring costs. And then in 2021, we did have that very significant pension credit when we launched another pension initiative for members to give them more flexibility, which was called a BPO, which is a bridging pension option. That was the main reason for the pension credit, giving us 6.7 million gain at the time and 0.2 million offset against that on GMPE, guaranteed minimum pension costs. But the BPO, the bridging pension option, gave, again, further options for members for early commutation of the pension rights. And then set against that in the previous year, we had much higher restructuring costs as we came out of quite a significant restructuring. That was 2 million in the previous year. So we can see now restructuring costs are a lot lower and the business is a lot more simplified. Moving on to the other key highlights, then other KPIs, underlying earnings per share. That's up 29%, so we've seen good growth there at the bottom line, 3.1 pence, and that's on a underlying profit after tax of 2.3 million. So that's up from 1.7. And then the basic, also diluted statutory EPS, that is significantly high, still at 7.9p for the reasons of the non-recurring gains, and that compares against 10.1p in the previous year. So that was a profit after tax of 5.8 million, again with the COVID grant, 2.1 million, the exceptional gains, and also we've got a further gain on the discontinued business from last year. So we had about 1.2 million last year, and we've got final proceeds now recognised in FY22 for the discontinued business. So that added a further gain to the bottom line. On return capital employed, Nick's mentioned this, we managed to increase that 1.2% points to 7.8 percentage points. Pretty low at the moment, as Nick said, and we're now going to focus a lot on this for the future to give the company strength and financial potential. So the definition, this includes discontinued business, but that will be fairly minor and immaterial in the future. And it's an average of net assets, and we've now excluded the pension deficit, which actually makes the return percentage lower than we saw in the 5-year profile in the ARA, but we think it's a more reflective returns measure. It does include over £20 million of goodwill that's registered in the balance sheet, and we intend to improve on that for the future. Moving on to the net debt, we increased net debt by 4.8 million to 32.4 for the year. And the key points of that: lease debt is now being used a lot more to grow our CapEx investment, and that was 3.8 million of the 4.8. The lower cash balances of 3.2 million was part of the change in net debt. And then against that, we had a COVID loan in the balance sheet, which has now been forgiven, so that gets written out of debt, 2.1, and we also take out of debt a net 0.1 on repayments of bank debt, which were 1.6 million, but we also drew 1.5 million on our revolving credit facilities. So that's where we finish with the bank facilities. They expire at July 2023, and we're currently discussing extending those facilities. Moving on to the divisional performance then, and Nick mentioned we'd look at certainly a tale of two halves, H2 against H1, and what happened there. We started strongly with manufacturing revenue up in second half by 3.8 million to against 47.5 in H1, and that was predominantly pass-through of inflation costs, which became pretty strong in the second half of the year. Tooling revenue increased very significantly by £7 million to a very high £16.1 million in the second half of the year. And that reflects a new major tooling contract, which is now ramping up nicely and straddles over a few years. So that will continue to go on for at least another year. In terms of the EBITDA, translated reasonably well, but down 0.5 to 7.2 million because of the inflationary costs. And that wasn't just in materials. We saw it right across the board in labour, in energy, consumables, distribution costs, all increasing in the second half of the year in particular. What we see here is a bit of a timing effect, that we have increased the prices, some in FY22, but most of our price increases have come through after the year end, very shortly after, from April this year. And most of those cost increases are largely passed on. Some do have to be absorbed depending on contractual positions and what is appropriate. And then the inflation pass-through, of course, does create a slight dilution of return on sales. So you get a slight mismatch in comparability of operating margin on sales as a result of that. What that means in terms of the operating margin in H2, that declined from 16.1% to 10.7%. So quite a significant percentage decline. And that was really down to a few things. You've got a combination of higher tooling mix and pass-through, the dilution of the pass-through of inflation costs to sales. So that would have been nearly a half of that, just less than half of the impact is due to that. And then the global cost inflation would be the rest. And what we see now is a timing effect that coming into H1, For the new year, FY23, we've, as Nick has already mentioned, we started to assess the cost increases and the price impact. And in the CTP kind of business, it's different from the aerospace business. It's not job by job. You have to weigh this up over a period of time. And once we understood the impact that we were seeing, then we went in with a series of price increases, which are mainly implemented from April, May, and June this year. Going on to aerospace, the EBITDA increased 46% to 0.54 million. So we're starting to see a good recovery in the aerospace division, and revenue rising 25% to 2.6 in the second half of the year. As said, the order intake is continually trending upwards. We're seeing quite a good uptake now in the short haul and the narrow body aircraft sector. Usage is increasing significantly there. Probably take a bit longer for the long haul and the wider aircraft, but seeing it start to accelerate the way it is very encouraging, and it's really exceeding our expectations. The increasing operating margin returns then we're getting by keeping the overheads very low and tight. Having said that, Nick has already mentioned that we are investing in very focused, specific ways so that we can grow the volume base and the capacity of the business. The price increases have done very well in the business, and as Nick also said, pricing on a job-by-job basis means that we've been able to maintain margin and actually grow the margin percentage in the year. So moving on to the overall income statement. So we've seen all these figures, but just to look at the whole picture in one, the revenue up 19.5%. That has been passed through pretty well through to operating profit of 25.9% increase, and overall operating profit up 69%. So we're getting quite a good pass through to the bottom line, despite the inflation impacts. We've also reduced greatly now rationalization costs. We will see little bits of this from time to time. There's still some things to do there, but nothing as major as we saw in the past. So that will be a good conservation of cash. And we've also seen some good moves in non-recurring gains in the pension gain from the pension increase exchange of 0.85 million there. And that, as I mentioned, offers members higher earlier pensions in lieu of inflation indexed. Finance costs have moved, of course, with increased rates and slightly higher debt levels. And in terms of the final profit on disposal of the technologies business, that's added 0.7 million to the bottom line. So overall, we end up with a very decent statutory profit. After last year, with exceptional gains reaching 7.4, we thought that would be quite unprecedented for some time. So to reach £5.8 million there, statutory profit, was a pleasing result. Looking at the net debt and what the key movements are in the net debt, just put a bridge there, and we can see that we started the year on £27.6 million and finished on 32.4, so a 4.8 million increase in net debt. Working capital outflows are the main contributor to the change in net debt, 3.6 million, and that's really driven by what Nick mentioned earlier, that we've increased inventory by over £4 million. Very uncertain supply chain post-COVID, causing quite a bit of uncertainty. So we have kept higher raw materials, in particular in specific areas, especially in polymers, to protect the supply chain. And as Nick says, we expect that gradually to go down. Won't be that quick, but that should gradually start to move over the forthcoming financial year. The pension contributions were mentioned, 3.9 gross, 2.7 net. Covered that earlier on the next slide. And then other cash from other operating activities with inflows of 9.4. That supports mainly our CapEx growth. So what you see is a consistent strategy in the business now where we have surplus cash. We invest as much as possible into CapEx for medium and long-term further future growth. The 10.3 million is not just a straight capital additions. That includes lease repayments, both for additions in the year and lease repayments for additions in previous years. So the actual CapEx in terms of cash CapEx was 4.8 million, and then other additions from leasing, which is now a growing source of our funds. That was £5 million. So looked at another way, the 4.8 million debt increase in terms of the categories of debt, we've got the lease debt increases of 3.8 million, lower cash of 3.2, and then the loan forgiven of 2.1 and the bank debt 0.1 million. So moving on to the shape of the financial position, balance sheet, we can see that net assets, PPE, property, plant and equipment, has moved up a net £4.9 million. So after depreciation and amortization, we're still seeing quite a gain there. Some of that is FX translation, but a good volume increase of 2.8 million. So we're investing at a much faster rate now than depreciation. And that's good for the medium to long term of the business. Increases in inventory, as we've mentioned, £4.2 million to protect the business at this stage, and not much movement in the overall other working capital. It's a small liability of 0.5. It was just over £1 million in the previous year. We've seen the reduction in the retirement benefit obligations of 11.3 million, which bolsters up the balance sheet significantly and has now led to a tripling of the net assets from 7.9 million to 24.4. And that really is a combination of the retained profit, 5.8 million, and then we've got actuarial gains going through there of 8.5 and FX 2.2. If we look at the overall cash flows, then the main highlights there, we've got a 4.5 million drop in the cash generated from operations. Again, mainly the working capital swings there. We did have a gain in 2021 on working capital of 3.7, and that has effectively reversed by 3.7 against 3.6. We would have expected not to see such a high reversal at the start of the year, but that was because we had to protect inventory this year. We see quite a higher position on interest paid at 2.5 million. That's 0.7 million higher, but that is really, again, effectively an accrual swing. We had a £0.5 million accrual in the previous year, which is now paid off. Tax slightly higher from higher profit growth, and we have disposal proceeds again this year, but 0.6 million lower than the previous year. And then cash investment on PPE, property, plant and equipment is 2.3 million lower, but that's because we are now investing more in leased CapEx. So in terms of the financing flows for 2022, as mentioned, we drew 1.6 million on the bank. We also sold and leased back 1.4 million in property, and we paid back to the bank 2.3. That's the 1.6 million mentioned earlier. And when we got the discontinued business disposal proceeds of 0.7 million, that was already pre-agreed that should be repaid back to the bank.
Thank you, Phil. So let me just sort of pull it together in a final slide. So I think the business has made good progress during the last year, despite the economic headwinds and the operational challenges that relate to any business that's growing at the rate that we are. And we definitely did see inflationary impacts pushing down our margins in the second half. As far as we can see, we expect those margin pressures to continue in the first half. And what we're seeing is a varying picture. You can all see what's happening to oil prices, which will continue to probably rise for a while. But things like labour look like we've already probably priced in and stabilised. There are some other costs that now seem to be stabilising, and supply chains are generally becoming more predictable, not back to the short lead times and deliveries we saw pre-pandemic, but they're at least not getting worse. I think what we can also see is, we've alluded to, is that the action we've taken on pricing, we think is now going to start feeding through to offset some of those inflationary impacts. But the underlying position of demand for both of our divisions looks pretty healthy from where we stand today. Phil's mentioned our current financing expires in 13 months, so we're in the process of discussing with the bank what comes after that, and those discussions are pretty well advanced. And this is about organic growth for us. It's about investing in CapEx, people and processes, and making sure that as our customers grow, that we can get a bigger share of wallet, that we can grow with them globally in the case of CTP, and we can bring on those new customers in aerospace. So, the way I think Phil and I look at this business is, we're sort of 18 months into this project of stabilising the business and then growing it. We're certainly now into the growth phase, and we think there's some more good opportunities to come. So with that, that's our formal part of the presentation. What we're going to do now is we have a number of pre-submitted questions, which we'll take first, and then we'll go on to the questions that you've submitted or are submitting now, and we'll do our best to answer as many of those as we can. So, Alessandro, Mark, do you want to start with the pre-submitted questions, please?
Yes, Nick, Phil, thank you very much for your presentation. And ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated in the right-hand corner of your screen. And we received a number of questions from investors, and I wanted to start off the Q&A session with these. And the first one reads as follows. It is good to see the reduction in retirement benefit liability. It is now 3 months since the year end. Can you give any indication of the current level of liability?
Unfortunately, we can't, because we don't get updated stats on a regular basis. And I also think it's one of those things that you have to look at it over a slightly longer period rather than a month-by-month basis. So there's nothing we can add, unfortunately, on that at the moment.
Thanks for that, Nick. The next question here asks, to reduce CapEx in the near future, why don't you propose to your customers to cash out the amount for equipment and then pay them a fee on products that you will sell them in the future to repay your share of CapEx?
That is a possibility, and it is something that as we grow, we will consider with certain customers. Some customers already do it with other people. So it is something that we could do to make our, if you like, our CapEx spend go further. So I wouldn't rule out us doing that in the future.
Thank you very much. And the next question here is a slightly longer question. However, I'll read it out in full for context. It reads as follows. The CARCLO board has stated that an updated schedule of pension payments for the next 3 years will be confirmed before the end of July based on data relating to March 2021. Since March 2021, there has been a highly material increase in the discount rate, with the AA corporate bond yield moving from below 2% to over 4% now. And we know from the sensitivities of the IAS pension calculation that such a move would reduce the pension liability by over 30%. Will this highly material change in the market reality be reflected in the new payment schedule? Also, management refer in the latest report to a change of investment management completed by the trustees over the year. Will this change in investment management be aiming to lock in the benefits of the higher discount rate environment such that we can protect against returning to sizable IAS and actuarial deficits seen in recent years?
Right. Okay. I'll take that one, Nick, shall I?
Yes, please.
Yeah. And unfortunately, I can't be quite as concise as Nick with such a chunky technical question, but thanks for a good question. I mean, there's a few points to make here. Firstly, the discount rates that are referred to here, they're applied to liability valuations, not asset returns. So they don't really translate into cash for contribution requirements in the eyes of the trustees. And secondly, the trustees would devise their contribution proposals on a much longer term basis, which is really based on their actuarial triennial valuations rather than movements in the markets just within months or within the year. So their eyes are on a much more long-term scenario. So that really affects the way they look at contribution schedules. I mean, they're looking at anything up to 20 years. Thirdly, they hedge liabilities against interest rates heavily. I mean, we actually have around 96% of the scheme's funded liabilities currently hedged against interest rates using liability-driven instruments. And the whole reason for that, of course, is that it's to guard against market volatility. It's members' funds, and market volatility is something to be guarded against. So that is already hedged in. So we're less prone to be able to either take opportunity from or be buffeted by significant changes in discount rates. And thirdly, within those hedge rates, then fourthly, the IAS 19 rates are based on bonds, not gilts. It's more of a technical matter, but you can have some mismatch there because the IAS 19 bonds don't always follow the same rates as gilts. Generally, the trends will be fairly same, but they're not always correlated that strongly. So you can get some mismatch there. And finally, the point about the investment management, while they're taking over, and we're very encouraged by a lot of fresh thinking there and some good strategic thinking, and very encouraged by their passion and technical skills and energy for improvement, they're pretty much locked into a long-term strategy that is already inherent there. And so because a lot of the portfolio is hedged, they can't break away from that, nor would the trustees and the scheme want to. So hopefully that explains some of those questions.
Thank you, Phil.
Thank you very much, Phil. And just turning to the next question, perhaps one for Nick. In the outlook statement, management state they expect the headwinds that prevailed in the second half will continue during the first half. Can we infer from this that as of the second half of this financial year, starting in October, the business will be largely through the headwinds?
I can't give any sort of forward-looking statements at this stage about what will actually happen. But I think in the question that I've already alluded to about what we see happening in the first half, we do think that whereas every cost we had was increasing in the second half of last year, it has started to abate in some areas, and that's why we think that, given that the position appears to be stabilizing, other than what's happening on resins, but we do think that the work that we've done on pricing means that we can offset some of that, and so hopefully, yes, we do see that the second half will be better, but it's a bit of a crystal ball at this stage.
Thank you very much. I'm just turning to the final pre-submitted question, which asks, does the company's current classification in chemicals reflect what it does? If not, is it time to reclassify?
I think that's a really good question, and I think it's something that we are thinking about, because I'm not sure chemicals does, to be honest with you. So it is something that we are looking at, and one of the things that I think we as a board are keen to do is to look at all aspects of the way in which we interface with the market, and so the classifications, how we communicate, when we communicate, I think are things that we're looking at the moment as we sort of move into this next phase of development of the business.
Thank you very much for that. That actually concludes the pre-submitted questions, but we've received a number of questions throughout today's presentation, and I'd just like to thank all the investors for submitting those. Nick, Phil, could I just ask you to read out those questions and give responses where it's appropriate to do so, and then I'll pick up from you both at the end.
Yeah, okay. So the first question from today is, do you have any plans to provide quarterly trading updates, as has been provided in the past? Would be greatly received by the shareholders. Thank you. I think what I'm not going to do at this stage is say, yes, we'll do quarterly, but I do think we will be doing more in terms of updating the market on things that the business is doing. In this period, we've been through the pandemic and then the inflation period. It has been about really focusing on making sure that the core business is in good health. And I think now as we move more proactively into this growth phase, I think there'll be more things for us to talk about and want to communicate. So whilst I'm not saying, yes, we'll do quarterlies, what I am saying is we'll do more communication as we go forward. Then the next one, again, there's quite a few now relating to pensions. How do you answer the point raised by some that the company is just a slave to its large actuarial, not IAS pension deficit and to its borrowings? And how might this problem be solved? For example, would you consider selling the Aerospace Division? Well, I don't see us as a slave to it. I see it as something that we have to deal with, both in terms of the pension deficit and looking at innovative ways of funding CapEx going forward, like we talked about on one of the earlier answers to the questions. With regard to the divisions, and I think what I said last time when asked this question was, would we sell aerospace? Both divisions are, I think, got really good prospects. They're both valuable, but I think there's more value to get out of each of them, certainly for the short and medium term. So whilst I wouldn't rule out selling aerospace or CTP, it's not something that I do now, because I think we can generate more value by improving the performance and the profitability of each one of the divisions. So yeah, it's something that we do look at. Again, as I said before, there is no reason why aerospace and CTP have to be under the same ownership. They do different things for different customers. So there's no corporate reason why they're there. It's all about maximising stakeholder value. Next question, again, another one on the pension. The reduced IAS deficit is largely meaningless for recovery payments. So with a draft triennial deficit of 83 million, the recovery plans payments are due to be going on for 20 years. Now the company is more profitable. Is the pension trustee not going to demand a more rapid deficit recovery and hence higher cash payments? So the way this works is in August 2020, when the tripartite agreement was started, there was a vision of a number of years to recover the deficit in its entirety. And we tend to, at that point, there was a commitment made to what the payments would be over that very long-term period. We actually fix on the 3-year period that's ahead of us. And so that's a process that we're currently undergoing in terms of fixing the pension payments for over that next 3 years. Apologies about the background noise there. So it's an issue that we negotiate with the trustees about what their contributions will be, but we do that in 3-year chunks. Another one on pension: if the pension deficit recovery is not accelerated through higher cash payments, and is the deficit going to act as a blocker on dividends being paid for the current 20-year period? Well, I would hope it certainly won't be 20 years. I mean, in the short term, we're not in a position where we can pay dividends, but I think, our objective obviously is to reduce the deficit to a point where it doesn't block dividends being repaid, but I don't think that's 20 years. So clearly, we would love to get back to a point where we can pay dividends. We can't see that being in the next 2 or 3 years, probably, but I don't think it's 20 years either. Next one, net debt excluding lease liabilities is increasing and interest rates are increasing. Are interest payments going to be an increasing drag on profits following the upcoming refinance? Phil, do you want to pick up on that one?
Yeah, I think, well, clearly we're now living in both a high inflation environment and a higher interest rate environment. And I think all we can say there is that just about not just the whole nation, but the whole world and developed world is in the same situation. So I'd say it will obviously affect cost of investment, but then in a competitive terms, it's relative. So we're not unusually, particularly more highly geared than the next competitor. So I'd say that marginally, from a competitive point of view, we shouldn't be materially disadvantaged.
Thank you, Phil. Next one, I don't think we can answer, which is, will the forward interest rates be spread, fixed or spread? I don't think we can comment on that one at this stage. Next one, is the company able to buy back shares instead of potentially paying a dividend, or is this also restricted while the pension deficit exists? We are, anything that we do with cash that's generated in the business has to be agreed between the pension fund and the trustees, and obviously our banks as well. So I think at the moment I can't see us buying back shares as an alternative to paying a dividend. Next one, how much could the business grow from here with existing customers alone without adding significant new product capabilities? That's a really good question. I think if I split that into talking about CTP first, the product range we've got tends to be the variance on a number of core components. And so in terms of the work that we're winning, actually none of them are particularly, they're generally getting more complex. They sometimes require 2 shop machines rather than 1 shop machines, but they're not outside of our existing technical capabilities. So I do think actually the opportunity to grow with our existing product range and capabilities, just more of them, is actually what our strategy is. We're not taking on particularly anything that's new technologically, or we are doing, as I say, more complex moldings, but not something that's outside of our comfort zone. One thing we are doing, by the way, is we are actively developing our technology so that we can, in the future, potentially move into some more higher value added areas, but we're not really putting that in our plan at this stage. With regard to aerospace, we'll continue to operate within the niches that we've currently got. We're very good at those. We're the sort of go-to people for certain products, and therefore I think we want to keep that nice focus. Next one, I don't think we can answer, is what would a 5-year operating margin aspiration be? I think that's too forward looking. In aerospace, what is in the vintage business? The vintage business is actually quite a lot about classic aircraft, which were generally operated and actuated on cable systems. So it doesn't sound like it should be a big market, but it is actually. There's a lot of older aircraft flying around, and a lot of cable aircraft are around still. So there is that's a sort of a legacy part of the market, but it will carry on for a long time.
It's probably worth saying as well, because we're very long-term established, we have a very wide range that goes deep to supply vintage business, which is a bit of a barrier to entry.
Yeah. Thank you. Yeah. The next question is, how do you see the encouraging performance and future outlook translating into share price movements at the market? Seems to not yet be recognising the potential you have outlined. I think sitting in the position that Phil and I do is, we can see what's happening with the business. We can see that, incrementally we're moving forward. We're making big steps forward in terms of our operational performance and our financial performance. We've seen a lot of fluctuations in the share price, and I can't see how a lot of it actually directly relates to us. A lot of it is about market sentiment. So I'm learning not to be too upset by the share price. I'd love to see it higher, of course. But when you look at what analysts say about us and what we do, which is Phil and I have both bought shares, quite a lot of shares in the last year or so. I would hope the share price could be considerably higher than it is, but we're influenced by market factors at the moment, which for a relatively small cap business like ours, we can't buck the market really. So Yeah, you know, the market does what the market does, but I think what we have to do is focus on the underlying quality of the business, and I think we are making real progress on that. So I think, is that the final question we've got today?
Yes, Nick, I think it is, and I think you've actually addressed all those questions from investors. And of course, the company will review all questions submitted today, and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Nick, could I just ask you for a few closing comments?
Yeah, thank you. Yeah. First of all, we really appreciate you taking the time to join us today. I think this is a really effective way of us being able to talk to many of you. This has been again a year of progress for us. One where we've been building the blocks for putting the building blocks in place for the future growth of the business. And we can see a lot of good signs happening, but we've got some challenges as every business has at the moment. So I think it's about working through those challenges, offsetting the inflationary pressures as we are doing, but then really focusing on that organic growth. So we look forward to talking to you in the future and hopefully giving you good updates on further progress that we've made. So thank you on behalf of both of us and the board for joining the call today.
And thank you too from me. Great questions too. Thanks.
Nick, Phil, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CARCLO PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.
Cheers all.
Thanks. Bye.